Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and this is our earnings analysis episode for Frontier Airlines Q1 2026 10Q filing, released May 5th. With me is Mike, our industry expert. Mike, we're looking at a quarter that shows some interesting contradictions. Revenue growth alongside significant losses.
That's right, Sarah. And if we reduce this filing to one sentence, it's this. Frontier is executing a painful fleet optimization strategy while benefiting from strong demand fundamentals, creating a tale of two different operational realities. Based on this filing, Frontier Airlines is operating in a structural reset phase. They're making hard decisions about fleet composition that are crushing near-term profitability, but potentially positioning them for the next cycle.
Let's dive into the material changes versus their prior filing. What jumps out immediately?
The numbers tell a stark story. Operating income swung to negative $283 million. That's a massive deterioration. Net loss expanded from $43 million in Q1 2025 to $272 million in Q1 2026. But here's where it gets interesting. Revenue actually grew 9% to $992 million. So we have this bifurcation between top-line strength and bottom-line devastation.
What's driving that disconnect?
Two major cost explosions. First, aircraft rent expense increased by $104 million. That's a 65% jump year over year. Management states this was primarily due to additional lease return expense, in part related to the early return agreement and a larger fleet. Second, maintenance costs increased $91 million, or 178%, which management attributes to the write-off on non-recoverable prepaid maintenance balances related to the early return agreement.
So this early return agreement is central to understanding the quarter?
Absolutely. In March 2026, they terminated leases on 24 Airbus 320neo aircraft, expected to be completed by Q2. The filing shows they recognized $139 million of operating expenses related to the early return agreement in Q1 alone. If this fleet optimization succeeds in improving utilization and reducing complexity, it could strengthen their competitive position. But if demand softens while they're absorbing these massive one-time costs, their liquidity position becomes precarious quickly.
Let's examine management's commentary signals. What tone are you picking up from the MD&A?
Management is notably cautious and repetitive about external monitoring. They use the exact phrase, "We continue to monitor the situation and the related impacts to our business," twice in the filing, once regarding trade policy impacts, and again about Middle East geopolitical tensions affecting fuel costs. This isn't confident, forward-looking language.
Any specific concerns they're highlighting?
Yes, they're quite explicit about fuel cost pressures. Management states that higher crude oil prices can increase our jet fuel costs, which we experienced during the 3 months ended March 31st, 2026. They quantify this. Fuel expense was $30 million higher than the prior year, driven by a 13% increase in fuel cost per gallon. For an ultra-low-cost carrier, that's margin crushing when you can't immediately pass it through to pricing.
What about their operational commentary?
There's a mixed operational story. Load factor improved 3.5 points, which is substantial and indicates strong demand. Revenue per passenger increased 2%, but capacity decreased 1% despite having 14% more aircraft in service, because of what they call a 12% decrease in average daily aircraft utilization. That suggests either operational constraints or deliberate capacity discipline.
Moving to financial red flags. What's concerning you about their balance sheet position?
The cash burn is severe. They generated a net loss of $272 million in just one quarter. However, they maintained $772 million in cash and equivalents against $588 million in total debt, so the balance sheet isn't immediately stressed. Their total available liquidity is $974 million, including credit facilities.
But there are some regulatory issues brewing.
Yes, and these are material. They received a preliminary TSA assessment of $42 million for the 2019-2022 audit period, and they've established a $77 million TSA reserve. Management states this is largely related to remittance of TSA fees for passengers that purchased tickets and did not travel. They also have a separate $133 million federal excise tax assessment they're contesting. If these regulatory disputes go against them, that's over $200 million in potential cash outflows.
That's a significant overhang. What about the labor situation?
They're in active negotiations with unions representing pilots, flight attendants, and aircraft technicians. Salaries and benefits already increased $22 million or 9% year over year. In this inflationary environment, with pilots having significant leverage industry-wide, these negotiations could meaningfully impact their cost structure going forward.
Let's talk about risk disclosures. Any new risks or escalated language?
The filing doesn't identify new risk factors versus prior periods, but management is clearly concerned about macroeconomic headwinds. They specifically mention that trade policy changes could lead to further weakened business conditions for the transportation industry and may adversely impact our operations through increased supply chain challenges, commodity price volatility, and a decline in discretionary spending and consumer confidence.
How are they framing the geopolitical risks?
They're direct about Middle East tensions. Recent geopolitical tensions and military conflict in the Middle East, including developments involving Iran, have contributed to volatility in global energy markets. They experienced this impact firsthand through higher jet fuel costs in Q1. For an airline with thin margins, sustained fuel price volatility creates significant earnings unpredictability.
Now let's examine their liquidity and balance sheet stress in more detail.
From a liquidity standpoint, they appear adequately positioned for now. The $974 million in total available liquidity provides a reasonable cushion against the current burn rate. But let's model this forward. If they continue generating $272 million quarterly losses, that liquidity gets consumed quickly. Their debt structure shows $588 million in long-term debt, and they mention adding Class A1 Enhanced Equipment Trust certificates, which increase their interest expense.
What about their capital commitments?
They have substantial aircraft commitments, firm orders for 161 Airbus 320 Neo family aircraft and 20 spare engines through 2033. Management expects to meet cash requirements through operating cash flows, sale-leaseback financing, and potential future borrowings. But if operating cash flows remain negative and sale-leaseback markets tighten, they'll need to access debt markets in a potentially challenging environment.
Are there any covenant concerns?
The filing states they're currently in compliance with all financial covenants, but with operating losses of this magnitude, covenant headroom could erode quickly if performance doesn't improve.
Let's analyze their segment performance. What's working and what isn't?
The filing doesn't break out detailed segment data, but we can infer performance from their operational metrics. Revenue per available seat mile increased 10% to reach adjusted RASM of $10.86, excluding the TSA reserve impact. That's solid pricing power. Load factor improvement of 3.5 points with 6% passenger growth shows demand strength in their core leisure markets.
What about their distribution strategy?
They provide distribution channel mix data, showing continued focus on direct bookings, which supports margin optimization. However, sales and marketing expenses still increased $2 million, primarily from higher credit card fees, which indicates transaction volume growth, but also rising distribution costs.
How should we interpret their capacity decisions?
The capacity management is the key strategic question. They decreased available seat miles by 1%, despite having 14% more aircraft. This suggests they're prioritizing utilization efficiency over growth, which makes sense given their cost pressures. But for a growth-oriented ULCC, capacity discipline can be a double-edged sword if it cedes market share to competitors.
Finally, what should traders and investors be monitoring, and what's your counter thesis?
Management is guiding investors to watch their fleet optimization progress. The early return agreement should be completed by Q2 2026, so we'll see if the operational benefits materialize in the back half of the year. Key metrics to monitor are adjusted. CASM excluding fuel. It hit 8.85 cents in Q1 versus 7.24 cents in the prior year. If they can't get that trending back down post-fleet optimization, the structural reset thesis breaks down.
What would prove your structural reset thesis wrong?
If load factors hold above their current levels while unit costs decline meaningfully in Q3 and Q4, specifically, if adjusted KSM excluding fuel drops back toward that 7.24 cent range, then this isn't a structural reset, but rather a temporary optimization penalty. Also, if fuel costs moderate and they can demonstrate positive operating cash flow by Q4, the liquidity concerns become manageable.
How does this change the investment framework?
Looking at the full weight of evidence from this filing, the structural reset thesis holds. They're absorbing massive near-term costs to optimize their fleet, while facing external pressures from fuel costs, regulatory disputes, and labor negotiations. At current margins, this equity trades like a distressed turnaround story, not a growth-oriented ULCC. The question is whether management can execute the operational improvements before the external headwinds intensify.
Any final thoughts on cycle positioning?
The timing is challenging. They're executing this fleet optimization during a period of fuel cost inflation and potential demand softening. If the broader economy weakens while they're still absorbing these restructuring costs, the margin for error becomes very thin. But if they emerge from this reset with a more efficient cost structure just as the next upcycle begins, they could be positioned for outsized returns.
That wraps our analysis of Frontier Airlines Q1 2026 filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. Thanks for listening to Aviation Intelligence Weekly, and we'll see you next time.
Thanks, Sarah. Keep monitoring those unit cost trends and liquidity metrics. They'll tell us whether this structural reset is working.